Okay. Okay, so the last group of analysis that we're looking at is profitability. So this one, all of these ratios are dealing with being able to see if we're able to generate profit. Okay, so are we able to generate future earnings? So it does, depend on obviously our income situation as well as our assets. Are we using our assets efficiently? The whole point of assets, which we've talked about throughout the last 2 semesters really, when we buy assets, the purpose of assets is to help us generate income, right? We buy them to help us. Like we have a delivery truck, well, it's going to help us generate more income. We have a factory, a warehouse, a piece of land, all of our assets. So when we're at this point, we want to evaluate, are they actually helping us generate income? Because if not, why do we have them? If we have a building that we're not using, why? That becomes an expense, right? It's not really an asset at that point. So some of them are just dealing with asset turnover and return on total assets. So those 2 are truly dealing with, are we utilizing our assets to help us make income? Okay? Or are our assets helping us use it, make income? Then we're going to look at return on stockholders' equity and common stockholders' equity, as well as earnings per share on common stock. We won't look at all of those, but we'll look at return on stockholders' equity and common stockholders' equity. And that's just, are we actually generating income from those investments? What are we doing with the proceeds from that common stock? Are we investing it in assets that then help us generate income, or are we spending it on, useless toys, which hopefully we wouldn't do that in a business, right? But, what are we doing and how is it helping us? And then we'll also look at like price earnings ratios. I don't think we did one on that one either. We won't do examples on those, but price earnings ratios, dividend per share, and dividend yield. So again, to look at kind of, are our other investments in our stock, are they paying off? The dividends we paying off, all of that. So let's look at assets first. Asset turnover, again, measures how effectively a company uses its assets. So here we take sales divided by average total assets. So again, whenever you see a formula that says average anything, you need to take the beginning plus the end, add them together, divide by 2, okay, to get an average. Or if they don't give you beginning and ending, last year's and this year's, it's the same thing, okay? So we don't include long-term investments in this, okay? They're unrelated to our normal operations and sales. So we're only looking at average total assets, excluding long-term investments. So we're looking at fixed assets, basically, okay? And current assets, but just not those long-term investments if we have any. So they give us, the beginning of the year and the end of the year. So again, first we would add those together and then divide by 2 to get an average total asset. So our asset turnover is our sales of $1,498,000 divided by average total assets of $1,048,750. Okay, and it told us our total assets and our long-term investments. So to get average total assets excluding long-term investments, we had to subtract out our long-term investments there. Okay, you won't see that or have to deal with that on the test really, but maybe on the homework. So it's good to kind of have a heads up there. So the asset turnover went from 1.2 to 1.4. This one's one where the higher it is, the better, that we have more assets. We're basically turning over or utilizing our assets at a higher rate, okay? Let's see, we'll talk about return on total assets and we'll do the little practice. Return on total assets measures our profitability of our total assets, okay? And we're not considering how the assets are financed. So it doesn't matter how the assets are financed in this one. So to calculate return on total assets, we're going to take our net income and add back in the interest expense, okay? So that'll eliminate any worry about whether they're financed by creditors or stockholders. So net income plus interest expense, and then we're going to divide by average total assets. On this one, average total assets does include the long-term investments. So we don't care, how they're being financed in this case. Okay, so asset turnover We exclude the long-term investments as assets. Return on total assets, we include it. So here they give us net income and interest expense. So we take that and add it together to get net income plus interest expense. And then we just want to take our total assets. We don't have to exclude anything from both the beginning and the end of the year and add them together, divide by 2 to get an average. Okay. So then we take net income plus interest expense, $97,000, and divide it by our average total assets. So return on total assets in 2016 is 8.2%, which is up from 7.3% in the past year. So as you can see, this is actually a percent. Okay, so return on total assets is a percent there. Again, the higher this number, the better. Okay, we're just getting a better return on our total assets. Okay. Any questions on those two? All right, well, let's do the practice on those two really quickly, and then we just have 2 more really to cover. Woohoo, right? So again, on our asset turnover, we're taking sales divided by average total assets, excluding long-term investments, and they gave it to us in that format. So this one's actually, obviously really easy. We're truly just taking 4.4 million divided by 2 million. Okay. So again, on your homework, just be aware when you're working on the one that gives you all the income statement and the balance sheet, you're going to have to subtract out any long-term investments on this on the asset turnover. Okay. So we just take 4.4 million divided by 2 million. Our ratio should be 2.2. Okay. That one's super easy. So again, the higher that asset turnover is, it's just more efficient use of assets to generate income. And then the next one, return on total assets. Okay, return on total assets. Again, here we're looking at assets and we're not considering how they're being financed. So we're going to take net income plus interest expense and divide it by average total assets. That average total assets on your return on total assets includes long-term investments. So 410 plus 90, so 500,000 divided by 5 million. Well, that one's pretty easy, right? It's 10%. And again, the higher this ratio is, the better. Okay, we just have 2 more to cover. Almost done, right? They start to run together, I know, so. And the last 2 we're going to look at are return on stockholders' equity and on common stockholders' equity. Return on stockholders' equity, it measures the rate of income earned on the amount invested by stockholders. So basically, what are we doing with the money given to us for stock? When they purchase stock from us, we're getting cash. How are we utilizing that cash? Are we seeing an actual increase in net income from it? So return on stockholders' equity, you just take net income divided by average total stockholders' equity. Okay, average total stockholders' equity. So again, we'd have to average the stockholders' equity, beginning plus end of year, divide by 2. So net income, 91,000 divided by average total stockholders' equity of 808,500. So here we've seen an increase from 2015 to 2016 from 10% to 11.3%. So again, these are numbers we like. The higher they are, the better. It means we're actually generating more income off of the common stock investments. Okay. As you can see, as we're going through all these ratios, this company has actually improved significantly from 2015 to 2016, which is always nice. It talks about just the return on equity is normally higher than the return on total assets. This is because of leverage. So leverage is just using debt to increase the return on an investment. So what that means is a lot of times, we're actually incurring some type of debt, here with long-term investments or stockholders' equity. So it's a different way of bringing in assets into the company. Okay. Let's see, what is that one doing? And then the last one we'll look at is the return on common stockholders' equity. This measures the rate of profits earned just by common stockholders. So we're not looking at, preferred stock and things, well, really just preferred stock. So here you're going to take net income minus preferred dividends. So we're excluding what we're paying in preferred dividends and dividing by average common stockholders' equity. So we only are looking at common stock. So net income minus any preferred dividends we paid makes net income $82,000, and then we look just at our common stock only to get an average. Okay. And again, this one's increased from 10.9 to 12.5%, which is, an improvement from one year to the next. So here they're just showing us how we calculated preferred stock. They had 150,000 of preferred 6% stock, so they took 6% of 150,000 to calculate what the preferred dividends were. That goes back to our chapter on stock, right? Chapter 12. So that's how they got the preferred dividends amount paid. Any questions on those two? All right, last practice. The last two, there's two little ones left. Or no, it's the last one. Okay, so our last profitability analysis ratios. A, return on stockholders' equity. So again, on stockholders' equity, we're just dividing net income by average stockholders' equity. So 1 million divided by 6.25 million. What's my return on stockholders' equity? 16%, good. 16%, which is pretty good. And then return on common stockholders' equity, remember we have to take net income minus preferred dividends. So that would be what? 950,000. And then we're going to divide it by average common stockholders' equity of 3.8 million. So 950,000 divided by 3.8 million. So what's my return on common stockholders' equity? 25%. Good, 25%. And that should be, your return on common stockholders' equity is generally higher since you're removing out the preferred, dividends, and you're only looking at common stock. Any questions on those? Y'all are ready to be done with ratios, right?